Yes, guys and girls, welcome back to another BMO video. It is Friday, the 12th of September. Now, as you saw, this week obviously was kind of waiting towards the end of the week just because we have a lot more data to go over. Obviously, on Tuesday, we just covered like a brief overview of what could happen and, what is the expected outcome and what may happen with price action. Now that we've had pretty much the important bits of data, let's quickly have a little look. So it's this one over here. Now, let me just scroll up a little bit. So as you can see, yeah, I mean, the start of the week was pretty quiet. We had pretty much nothing. Obviously, it was the French politics, Japan as well. But so far, that's been relatively contained. We're not really seeing that much of a big issue. I don't think markets are really expecting it. If you're looking at like euro price action, doesn't seem like they're too on board the view that it could spiral out of control. But who knows? It could literally happen today or tomorrow or whenever. It's just you just got to keep up to date with it. But so far, we haven't really seen anything that would suggest it's getting worse. Then Wednesday, what did we have? We had CPI from China on the negative side. So overall, that hasn't really driven the AD too much, to be honest with you. I think Australia's kind of following a bit on the dollar and what that means for like risk sentiment, etc. Then PPI. Now, obviously, Schlegel did speak, but I didn't see anything of interest there. PPI, it gave us a bit of a guidance or rough guidance on the inflation. It did go into negative on the month-over-month prints for both core and standard. So obviously, that's deflationary in its nature. So people are like, okay, maybe CPI could come in a little weaker. It doesn't generally follow suit, but that's just the general thought process of, okay, maybe if there's less producer prices, i.e. they're paying less for goods to then sell on to us, then generally they should technically lower prices for consumers as well. But obviously that will take a long, long time. Nevertheless, Thursday we saw Hawksby. I didn't see anything of interest there, but I'll double check it on sort of Bloomberg or another website. ECB, obviously they weren't expected to do anything, so they held interest rates as expected. Initially, what you may have saw, we did see a weaker euro on the actual print, and that was because of them downgrading their growth forecast slightly. But then, as you all know, that was just the reaction. And then afterwards, Lagarde was pretty hawkish. So people drove with that idea. Just a little bit of a downgrade to growth isn't game changing. As a result, markets still went long, even though we saw a slight weakness in the euro. In addition to that, we had CPI. Now, obviously, CPI was a tiny bit stronger. But what people did notice was the rise in the unemployment claims to 263. Obviously, not a good sign. I believe that was because it was Labor Day. I saw somebody on Bloomberg, I think yesterday, saying that that was because of Labor Day. So we'd have to see if this next week it follows suit or not. Because as you know, last week we did see, I think it was bank holiday for the US. So obviously for that day, there was pretty much nothing. So people are like, maybe it's just because of that. Nevertheless, you have a good guidance of that next week and seeing if there's a trend forming or not. Then obviously Lagarde, she was speaking and she was pretty hawkish. So obviously the euro went higher. Then today we had GDP from the US, from the UK, pretty decent actually, especially this one here of services. That is pretty good for the UK in particular. And then towards the end of the afternoon, we have consumer sentiment. Is not really expected to move much, as you can see. It's not really been a market driver at this point of time. It has been previously, but it only becomes really prevalent or really like in your face sort of thing when markets are really, really like down in the dumps with the US. So people just want to see, is consumer sentiment really dropping off, or is consumer sentiment really rising when you're seeing lots and lots of growth? So far, we're just seeing a gradual decline of the US labor market. As a result, it's become a little less prevalent for now, but who knows, maybe in the future it will become prevalent, especially when there's like recessionary fears. That's when it becomes like really important. Now, the DXY, you can see, obviously we saw Tuesday's price action, then, wrong week. Monday became stronger, then obviously bang, and then we've pulled back a little bit now. Obviously, this is also driven by this as well, which is the ECB. Gold, you may have noticed, gold has been starting to gradually move higher. Dollar yen as well. We did see a nice move to the downside. We're seeing a bit of a pullback now. But overall, what we have to think here is, based on what we know, or based on what we saw this week, does it suggest more weakness in the dollar? I would say yes, personally. That's why if we see the pullbacks happening right now, this is opportunity. So that's myself on the dollar, on the news. Sorry, let's move straight on to the US. So the US dollar. Now, obviously, as you know, today or this week was all about CPI. Let's just quickly have a little look at what this means for the dollar going forward. Obviously, if you are looking at the DXY, you also have to consider the ECB meeting as well. But nevertheless, let's just look at face value and just think, what does this data actually suggest? So let me just quickly show you this daily thing. I read it this morning and it was pretty decent. And it says this: 3 cuts validated. So let's just quickly double check whilst we're here. What is the expectations so far? So as you can see, obviously, markets do expect a 25 basis point rate cut from the Fed in next week, isn't it? Yeah, next week. Then October is a cut, and then December is a cut. So you can see, yeah, pretty much 3 rate cuts from the Fed. Can they increase? I don't think, to be honest with you, that they may increase the pace, i.e., they do like a 50 and then 225s. You'd need to see like significantly weaker data for that to happen. But I mean, we are definitely slowing down, and when a pace picks up, it does tend to pick up. So who knows? Maybe, you know, next month or the month after, we see really, really weak data. But nevertheless, the CPI yesterday showed slightly hotter than expected inflation, while the closely monitored core rose by 0.3%, which is in line with consensus. What matters the most is the limited tariff impact. Price increases were driven by airline fares, used cars, shelter, food, and energy, while recreation and medical saw declines. Notably, core goods, because you've got to remember, right, when all of the tariff thing happened, I think around April, people were like worried that this is really, really, really going to spike inflation, but you can see it's not really doing that. So people are, okay, maybe the Fed may be able to cut by more now in the future, because previously people were thinking maybe we see like a really big rise in inflation, Fed may not have to cut by as much. But now that we can see that the tariffs haven't really affected inflation as much as people are expecting, people now think, okay, because we're seeing a weak labor market, this should also give the Fed some room to cut by a little bit more. Notably, core, excluding autos, rose by 0.1%. Obviously, we saw that PPI services traded this week. It so far guaranteed that the profit squeezing is sustained, but for now, markets are receiving validation of Fed dovish bets, which, as you know, is expected because we're not really seeing the tariff impact. Now, what we did also note at the start was the rise in the initial jobless claims, which is not a good sign. But people do say it could just be because of the Labor Day last week. So we'll just have to see next week's initial jobless claims or the unemployment claims, as it's shown on here. Both exactly the same, just worded differently. Does next week's unemployment claims come in lower as well? If that's the case, then people will begin to think that now there's a trend starting to form. Now, here is our preview for the Fed. We'll look at that next week anyway. But markets are expecting a dovish Fed, which, as you know, seems the most logical play because, well, since the last meeting, what has happened? While we've seen a lot of data weakness in the labor data, we've not really seen too much tariff impact. So the Fed can't really be hawkish in that environment. As a result, that's why we're saying any pullbacks that you see. So the Fed meeting is, I think, on the 17th. Yep, here at 7 o'clock in the evening. Well, we have to, and obviously they do have the dot plot there as well, which we'll look at on Tuesday's breakdown. But you have to be thinking now, what is the direction of least resistance on the dollar? Well, for you to go basically back bullish the dollar, you also need to see other people being pretty weak as well. We're not really seeing that. In addition, you have to also see good US data. We're not really seeing that. So logically, the direction of least resistance is obviously lower. That's why any pullbacks they see, like on dollar yen right now, like on euro dollar, obviously pulling back to then go higher again, is opportunity. Because what you have to think is, or how you basically interpret it is, what we've seen this week or what we've seen this month, what does that suggest for the theme? Because we know the theme is the Fed or just central banks in general. Based on what we've seen since the last meeting till the next meeting, which is obviously next week, has the data been really good or has the data been really poor? That's the questions you have to ask yourselves. Well, we could argue it's been pretty poor. As a result, you could suggest that you should have a dovish Fed. That's pretty much how you interpret. Obviously, we see the surveys today, but overall, it's not really going to do anything. And they say the balance of risks remain tilted to the downside on the dollar, which is obviously true. And obviously, we'll look through the euro one in due course. Now, let me quickly open up this. Let me share my screen. Now, let's have a little look at UBS's view on the dollar. And they obviously say all eyes on the Fed meeting. 25 basis point cut is more than fully priced in, while 50 would come as a dovish surprise, obviously. Apart from the rate decision itself, markets will closely watch two things: the updated dot plot, which currently shows 2 cuts for the year compared to almost 3 being priced in by the market. Powell's tone in the press conference for clues of future direction. Because markets already expect a rate cut from September or next week, you know that that's not going to move markets because people already know that and they already priced it and they've already expected it. What we have to think about is the dot plot and what Powell's tone is, as you know. Now, a more hawkish stance, like sticking with 2 cuts this year, could support the dollar, while any dovish shift towards more easing down the road may weigh. So consider like 2026's profile. Do they expect a lot more rate cuts in 2026, for example? Thursday's retail sales were sales, but they will mainly serve as a context for the Fed's decision. Overall, we expect the Fed tone to shift more towards dovish, given the recent labor market weakness, matching markets' expectations, and obviously a weaker dollar. We continue to target 121 for euro dollar by year end and AUD USD at 0.68. So I'm more on the camp of 120, just because it's a nice round whole number. We're at 117. It doesn't seem to, 121 would be amazing, obviously. But 120 is just like that nice round whole number. I just want to see if there's anything. Let me double check if they have their forecast on this stock. I don't think they do. Now, lastly, whilst we're here, let me just open up this document. Well, not document, but the Bloomberg article. And this is what they have to say. Now, dollar sets for the steepest weekly drop in a month before the Fed meets. Well, obviously, why does it go lower? It doesn't go because technicals are suggesting it to go lower. Fundamentals tells you where technicals are going to go in the future, right? So if you can understand what fundamentals is going to do right now or in the future, based on what we know and what would be expected, you could suggest that technicals would go lower for the dollar. As a result, that's why we're saying that any pullbacks you see would be opportunity, regardless of what technicals are suggesting. Use technicals as a tool for entry. So that's when you want to wait for technicals to turn bearish before getting in. And now that's when you have a technical confirmation and a fundamental confirmation. Now, the Fed's interest rate cuts will be damaging for the dollar, said Michael at Commerzbank. I believe that's a German bank. Still persistent inflation means its downtrend will be slow bleed instead of a big bang. If there's like a big bang, then generally what we could see is actually the dollar go higher because of risk sentiment or safe haven, as you know, as we've seen before. Markets have largely baked in the prospect of a cut from the Fed next week. At the same time, they'll be scouring this decision and comments for evidence of concern about lingering price pressures. CPI, obviously, this week doesn't really suggest that. So I don't think that will have much, juice to the trade, I guess. But investors are less exposed to the spot market, despite being broadly bearish, according to current traders familiar with flows who are not being asked to be identified. So that could, if that's the case and they're less exposed to the dollar, then when something really comes through, then they'll really jump on board. That's kind of how I would interpret that. Now, in regards to technicals, dollar CAD, we are trading a little bit higher, but I don't like the reason you would be trading dollar CAD is purely the dollar leg of the story. So obviously Canada is weak at the moment. And you can see we're actually reacting out of a daily supply zone. Yeah, actually that technicals looks okay. We haven't really got a clean break below the low, though, so it would be a little bit of a riskier trade to get in. But CAD is also weak, and so is the dollar. You have to think what is going to be the main driver here. It's likely going to be the dollar. So if you know you're going to be pretty bearish on the dollar over the next, couple of months or so, you are likely to see dollar CAD go lower. That's kind of the premise of this one. So it's up to you if you want to trade it. Again, that technicals, that's the higher low before it made the higher high there, because that's the higher low, that's the higher high. It's the higher low that made the higher high. We didn't really get a clean break there, though. So it may be a little bit of a risky trade. But I wouldn't argue against that. Dollar Swiss. It's up to you, I guess. But you can see technicals are massively bearish for obvious reasons, but we are kind of very choppy. So it's completely up to you if you want to be trading that environment. I personally wouldn't. Dollar yen, even on the daily time frame, that does not look amazing or appetizing. But what we do have to consider is what would the future be for the dollar at this point in time? Probably likely lower. And interestingly, what we are seeing is a lot lower on the 10-year. And the 10-year is a large driver of the yen. So that would be expected to go lower as the labor market weakens further, because obviously 10-year represents growth. So if growth begins to falter and go lower, then you would expect 10 years to go lower. And as 10 years go lower, that drags dollar yen lower, or in other words, drags yen higher as a result of that. So I want to be getting into a sell. I think just at the moment, technicals are a little bit choppy or a little bit ugly. So if you want to wait for something to present themselves a bit better, that's probably what would be expected. So I'm just trying to see if there's actually anything here. No. So you're going to have to probably wait for a bit of better technicals, like some lower highs being created. For example, like this, very nice technicals. You can see here that we came to make the lower high, but just kind of struggled. So it looks like the direction of travel is lower, which should technically happen. It's just technicals are a little bit choppy at the moment. So overall, I would like a bit more bearishness on that. Now, regards to the pound, because we'll just cover all three at the moment. Regards to the pound, today, what you did see was GDP. Now, services, I did see a LinkedIn post from Mohammed Al-Ariam. He said UK monthly GDP was flat with consensus forecast. This brought the 3-month figure to 0.2%. Also, as expected, the surprise was the underlying components. Obviously, a larger than expected decline in manufacturing production, not really of a big deal for the UK, but a stronger performance in the construction and services sector. Obviously, this one is the most important, the services. And obviously, that comes as the UK government prepares its pivotal annual budget, which has been pushed back to November in the midst of significant political and market discussions about potential measures. I thought it was around September, October, but I guess it just got pushed back to November. So, yeah. All you have to do now up until November, because obviously that's going to be like a big event, is just watch the data to think, does the government, what they want to do with taxes or spending, does it make sense for them to do that or not? Now, what we did see was, if I quickly show you this trade from, where are we? Nomura, they're actually looking for short GU, and let's have a little look at why. It's always important to look at other people's points of view, because it gives you a rough idea of what you could also consider. Obviously, it doesn't mean you have to change your idea. If it makes sense to change it, then obviously you do, but you don't just say, oh, I'm looking for a buy, but this bank's looking for a sell. Obviously, they'll have different views to you. Some will have the same views as you. It's just you have to go with what you are doing. Don't be influenced by other people, basically. So let's see why they're suggesting short GU. The conviction 3 out of 5. So if I remember correctly, that is around 1/3 of their risk into the trade. 5 out of 5 is 100% of their conviction risk. So I don't know if they want to put in, I don't know, let's say £500,000 into one trade, then obviously 3 out of 5 conviction means they're only going to put 1/3 of that 500,000 into a GU trade. And then as their conviction levels increase, maybe something's happening, then they'll add more into that. Just because if your conviction level is not higher, but you're still risking a decent amount, that's more gambling. You're not really trading with like conviction or high conviction. It means it makes sense for now, so it's worth trading. But if I take the loss, I've only lost a little bit, 1/3 of it. Now they obviously are looking for short GU, as we see greater downside tail risks for GBP regarding the BOE's quantitative easing announcement on the 18th of September. The challenging UK budget coming into view on the 26th of November, and some room for a tactical dollar bounce. So what they're saying here is negative tail risks to GBP from QT, quantitative tightening announcement, and underlying physical challenges. I guess the physical challenges would make sense, just because, again, like what the government wants to do with their taxes is obviously not going to do good for growth. I just want to see what they're saying here. So they're saying the 18th of September will likely be uneventful from an interest rate perspective. Market pricing implies less than 1% chance of a rate cut, and we also expect no move in the bank rate. Rate cut pricing has been reduced significantly now, and with the next cut not fully priced until March 2026. Therefore, we see some scope for easing to be priced in than out, as economic indicators remain mixed and the most BOE rate settlers view policy as restrictive. However, this is not a primary tail risk to the GBP. So if we just dissect that, we see scope for more easing to be priced in than out. So obviously being more easing to be priced in means markets expect more rate cuts. How do you determine that? Well, that's when you look at the data or you look at speeches or any commentary that would suggest that. So I guess so. I mean, until March 2026, that's a long, long way away. So yeah, I mean, that would make sense for more pricing in. But like they're saying, this is not a primary tail risk for the pound. So basically, in their view, that's not a main reason to be bearish the pound. We think FX markets should focus more on the quantitative tightening announcement. And that is, I have made a monetary policy video. It's on the education. It's also on the YouTube as well, if you want quick access. But I did speak about QT. Now, pound has generally been more negative correlated to large rises in gilt yields, as we saw when the big spike in yields we saw, I think like last week or the week before, pound was under pressure then. But considering both our house view and the potential reaction function of gilts and GBP to such an environment, we think the risk to reward is being short pound into this event is attractive. Now, they're actually looking for a bit more of a tactical bounce in the dollar. And they say, let me just briefly read through this. I don't think I have the AI thing on this one. No, softening the current market year end. Disappointing reaction. Supportive. So they're basically suggesting more negatives are in the price rather than what should be expected in their view. So if that's the case, they're saying that people could dial back a bit of their negativity, and that could allow for the dollar to bounce. I guess that does make sense to a certain degree, but we have to think, why would they do that? So why would they reduce the amount of rate cuts expected? Well, what you'd have to see is like pound next week be pretty hawkish or push back on that. You'd have to see the likes of like labor market data holding relatively steady or increasing a little bit better. If that's the case, then yes, that would make sense for the dollar to bounce a little bit. But for now, I don't think that is the case. I could be wrong, obviously, because, you know, we've got until the end of the year, but they are looking at it more towards the end of October. So they're actually suggesting that it could be quite soon that we see a big dollar bounce in that regard. I mean, right now, GU is at 135. So they are seeing, well, 135.3. So 530 pips or so. It's doable. But remember, markets move because of reasons, right? They don't just do it because they want to do it. If they have a reason to go bullish the dollar, then they'll go bullish the dollar. We have to ask ourselves, does it make sense for that to happen right now, based on what we know? Probably not. So it could happen. We just have to monitor what's happening over the next few weeks or so. Now, that's their pound view. I mean, it's a good view. Don't get me wrong. I do like it. And it's important to look at other people's views as well. Just take into account what's happening. Now, they are looking for, well, there's more GDP was in line with consensus. Nothing in those figures carries significant implications for the BOE. Next week, we'll be busy for jobs and inflation numbers. Obviously, their cut is for a November cut. It remains more dovish than markets expect, and they see upside risks for Euro GBP. So you can see that if you are following, like just blindly following what people's expectations are, they're suggesting the pound could go much weaker because they expect a rate cut in November, whereas Nomura is suggesting that there shouldn't be any rate cuts this year from the BOE. So therefore, you should go long the pound, short the pound in that regard. So I don't really see what they're suggesting in that. Remains more dovish than markets expect. We see risks for Euro GBP, but not only into those markets. Euro may run lower end. Okay, so looking at actually more in regards to the euro for this trade. You see what I'm saying? Like they're suggesting, Nomura suggests a 130 for GU. Cool, that's 500 pips away. Why are they suggesting that? Dollar long bounce, and they expect in the future more rate cuts to be expected. Cool. That would make sense, but are we seeing that right now? Probably not. So to them, they're happy to take that trade, but for you, you may not be happy to take that trade. So again, that's why you have to have your own view. Some banks might say go long the pound, go long GU. That would make sense at the moment, and that's what we should continue to trade at the moment until something changes. Now, let me see if there's anything else. I don't think there is. So you can see that pipe to resume rallies, says strategists. They're saying go long GU. Others saying go and short GU. Again, have your own view first. See what other people are suggesting afterwards. Now, the BOE's hawkish pivot in August has certainly played a big role here, preserving sterling in as one of the few currencies still paying 4% annum on 1 week deposits, which is obviously quite a lot. Thinking about these people who are investing millions, 4% is obviously a lot. Now, we can, at the big event, obviously on 26th of November, but expect cleaner dollar trend to be dominant factor at this point in time. Here's a little good thing for you to do. So I don't know if you can get it in Chrome, but on Firefox, what I'm using now, if you are unsure about what stuff means, so for example, if we just bring up this and then you read through this, you're new to fundamentals, you don't really have a good idea. For me, you could do this and explain this. It'll then open up for me this on the side, enter, and then you can see how it explains all of what this is. So this is a good tool for you to use when you're starting out, and they even give explanations as well. I think you may be able to get it on Chrome, but for me, I have the ChatGPT extension on Firefox. So if you need to use it, you can use it. But yeah, just use that if you need to as you're starting out. Now, I don't think I have anything else to add on to that. I would be more in the camp of tactical strength and tactical weakness. For example, we spoke on Tuesday how you may go long GCAD, which is basically what we've seen this week, but short GA. So you have to trade tactically. Long GU, but short GA, for example. Was looking at GJ, but the N is actually a little bit weaker for some odd reason. GN, you can see how you may be long certain currencies, but short the others. I think that's still the same thing up until BOE next week. BOE will then suggest something or say something. Obviously, we do also have some inflation as well, by the way. They'll then suggest it or say something. And then that could give us a good guidance of what could happen in the future based on what they've said. So for now, I think that's what I would be doing up until that meeting. And then after that, maybe something changes, maybe something doesn't change. We'll just have to wait and see. But for now, GA, yeah, it seems like that's the case. We did actually react from these lows at 204,700, basically around these lows is where we rejected from. We had all of these pullbacks, very shallow pullbacks, it seems. Delete this. We initially reacted from here on the supply zone on the daily. We've not really had any pullbacks. If you go on the 4 hour, you can see how we just basically pulled back to these last lows, 4 hour supply zone, and then a nice pullback. Ideally, or a nice little move to the downside. Obviously, ideally, we all want a higher pullback. We don't always get that though. But a higher pullback would be around there to 206 and then a sell-off. Over the near term, what I would be focused on is basically similar to this price action, what we've seen. If we're going to have shallowy pullbacks, then around this region here would be of interest to me. GCAD, we were looking for upside. We just didn't get any major pullbacks. If we go on the 4 hour, you can see that's very, 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 very shallow. The next point of interest would be probably around there on the 4 hour, which also lines up with, as you can see on the left, previous highs. So if we just mark out the open, you can see previous highs being met. And if we just round that to a whole number or a quarter number in this point, if it's going to open up, 87,500. Oh, no, 87,250. Sorry, 87,250. And that would line up around there. So basically anywhere within, let me just extend that box there, would be of interest for me. G Swissy, I am not looking at. GJ, we were looking for some sells on the basis of yen strength, but we are actually seeing a bit of choppiness. So I just wanted to see what this quick thing is saying here. I don't think it says anything for the yen though. It's opening. Did we have anything this morning? No, I think what this purely is just dollar pullback is a bit on the yen weakness side. Would make sense. But because we know eventually the yen or the dollar should go lower still, that's why we're still looking for some shorts. I don't think right now is probably the timing element. Technicals anyways is kind of a bit choppy. As you can see, we're not really breaking any structure. So we don't look for sales just yet. But for now, it would seem adequate to sort of suggest that view. We just need to wait for technicals to present it. GN is kind of following GA, I guess. So if we look at this 12-hour supply zone right here, basically we're at now. If you look at the S&P, because basically what we saw was CPI and obviously the Fed, and you can see the S&P has continued to rally. Would make sense. There's not that much doom and gloom. Just because we saw last week's NFP, which is this, being really, really weak, doesn't suggest that now you now need to scream recessionary fits. It doesn't really point recessionary. So even though we did come in lower because of the NFP coming in a little bit on the lower side, it doesn't suggest doom and gloom. So that's why I believe we spoke about on Friday or last Friday that it wouldn't really point doom and gloom. As a result, it went higher again. So that's when you just still look for demand zones, or like in this instance for GN and GA, you still look for supply zones because you'd want AUD strength. And then lastly, GU, we spoke about the 135 handle on Tuesday. We actually did react from there nicely. This is CPI print, this one here. As you can see, the sort of CPI print right here. What was on Thursday? Yeah, we saw the reaction around here. Cool. 11, 12, 1. This candle here. Nice big reaction to the upside. We do also have to notice actually we broke some structure here. Cool. And then waiting demand zone right here, which we did actually react from. So yeah, for now, what I would be considering is that, I mean, right now the reaction hasn't been the greatest. Just going like the 15-minute, for example, hasn't been the greatest. Let's see if we can follow through. If we have a nice big old push, then you can see that we are kind of creating a 50-hour demand zone there. A 15-minute, sorry, demand zone. I don't like trading like that, but that's what you'd be doing if you were looking at the lower time frames. But nevertheless, that is myself actually. Again, like I said, probably more, well, tactical. So you might be long GCAD, but short GA, for example, because at the moment Canada is really, really weak, a lot weaker than the UK. Australia is a lot better off than the UK. So that's why GA shorts would make sense, but GCAD longs would make sense as well. So it's just about being tactical for now until we have like a much better grounding on what's expected from the central bank, which will happen next week. So hopefully something happens from that. Now, in regards to the euro, let's have a little look. Now, as you can see, obviously we did have the ECB meeting. That was pretty much what was all was expected. If I open up the policy decision, and then I'll get up the euro as well, which was this candle. But if I go on the 15-minute, you'll see it a bit better. So you can see the event was at quarter past one, and the quarter past one candle massively bearish. Makes sense. We saw the growth projection for 2026 is now slightly lower at 1%, while the projection for 2027 is unchanged at 1.3%. Cool. That makes sense. Why the reaction was a little bit weaker. Overall, it was in line with a lot of people's expectations. That's fine. But what we have to consider is, does that then suggests more weakness in the euro in the future? Probably not, just because the large amount of the data in the Europe is still pretty good, still fairly stable. The ECB is pretty hawkish, which Lagarde suggested or showed at her press conference 30 minutes later, which then, if I just quickly show us we'll read through all of this stuff later on next week. So let me just do this. And decision to keep rates low, the ECB unanimously decided to keep rates on hold. And all of Lagarde's remarks throughout the commentary were crafted to convey a strong sense of conviction behind the ECB's position, which is to hold rates for much, much longer. Lagarde said the disinflationary process was over. Risks to the economy were more balanced than before, and the inflation outlook was well behaved. She also dodged any questions on France. They had tried to keep a neutral tone, but it seems as if she was kind of suggesting that it should be pretty much sorted, and she doesn't really see it outright going crazy, essentially, which is good news for longs on the euro. But who knows? We'll just have to basically just monitor it every week, just if anything's been said, anything suggesting it, etc. But historically, it's only happened a couple of times, so the odds are in our favor that it shouldn't really go really, really bad. At the same time, however, looking at the details of the latest star projections, there are still downside risks to inflation, and hence the door for another cut remains open, even though Lagarde might not agree right now. The forecast for core was revised downwards and could even touch 1.7% in 2027. Also, the technical assumption of unchanged interest rates until 2027 clearly suggests that the risks to the ECB's good place are asymmetric. Undershooting inflation now appears more likely than overshooting. As a consequence, although the threshold for another cut has been set high, we cannot entirely rule out a possibility that the ECB may be forced to abandon its good place in the coming months. Again, that's fine. That's like every central bank, really. If the data suggests it and you're wrong, like what we saw with Canada, where basically Canada has kind of stopped cutting their interest rates. But what we've seen recently on the inflation data and the growth data, it's been pretty weak. Hence why, if we just quickly open up, if I just quickly show the heading, set to resume cutting in September, December. So if the data suggests it, then yes, obviously the ECB will have to cut. But right now, it doesn't suggest that. So that's something to consider in the future, but it's not a tradable thing to trade right now, is it? Like, you can't trade the uncertainty or the not knowing of what could happen. Like, for example, selling the euro because of the French government. Well, nothing's really happened yet. So you're kind of trading on hope it will happen. You see what I mean? So if something from a data perspective does come out that suggests cuts, then yes, that's when we can trade the euro lower. But for now, doesn't really suggest it. So we can't really trade it. But something to consider in the future for sure. Now, I just want to see if there's anything else on here. That's obviously their forecasts. The pink one here is yesterday's forecasts versus others. So you can see on inflation for 2026, a little bit higher, 2027, a tad bit lower, but pretty much the same until 2027. And you can see GDP was revised down for 2026, but stayed the same for 2027. So overall, pretty similar to last meeting. Anything else here? No. UBS, they are suggesting, let me quickly share my screen. They're really suggesting some really weird trades, like selling gold versus the euro. Never known anybody to trade that before, but why are they saying that actually? Out of curiosity, from most of this year, we expect trend to continue, supported by dollar. Yeah, cool. They're still looking for gold upside, which would make sense. Now, French politics and Fed likely to move the euro. Obviously, right now it's the Fed. The French politics have kind of died down a little bit, but can always flare up at whatever time. But they obviously gave a more balanced outlook. The withdrew downside risks. We expect these to be easing again, but it is remaining on hold for the time being, which is supportive for the euro. Next week, the currency will be primarily influenced by French politics, Eurozone data releases, and obviously the Fed meeting. After this week's fall of the Bayrou government and the nomination of Lecornu as the new French prime minister, markets will be keen to know how the new administration will tackle open issues until the budget is submitted in early October. Furthermore, a potential credit rating downgrade is likely to weigh in the euro, despite being widely expected. They say another major driver of the euro, especially euro dollar, will be the outcome of the Fed meeting. We all know that right now the main driver of the euro, or in particular euro dollar, is obviously the dollar leg. If investors move out of the dollar, the euro remains the default option. And the question you have to ask yourself is, why would they move out of the dollar? Well, dovish Fed, lower yields, weaker data like we've seen this week. This is all suggesting people moving out. More hawkish euro, so yields should stay higher in Europe, which is attractive for people. But despite short-term volatility and potential setbacks, we expect the euro dollar to break above its recent resistance in the next few weeks and move closer towards our target of 121. Cool. I would agree with that, actually. I've got nothing else to add on to that. Now, in regards to technicals, because what we have to consider, right, is based on what we saw this week, does it suggest higher euro or lower euro? Well, we could all argue that it probably would suggest higher euro, right? As a result, we have to be considerate of who we are trading the euro against. Well, EA right now, pretty bearish. That's because AUD is very, very strong. It's benefiting a lot from higher S&P, by the way. So Euro AUD, like what we spoke about on Tuesday, probably could come lower, but that's on the basis of AUD strength, not because Europe is weak. EuroCAD, now we basically just reacted out of this 4-hour demand zone that we looked at. Obviously, the ideal situation that we spoke about was that 50% pullback, but we haven't really got that, to be fair. So right now, we saw a reaction, but I mean, we could all argue that's not exactly the best reaction. So based on price action alone, I wouldn't be surprised if you do pull back a little bit before initially going higher. You can see that we're creating a lot of wicks, which is indication of a reversal. But I don't think right now they have that reason for a reversal. So that's kind of probably why we've not really seen it. Just because Euro is really, really strong. Canada's really, really weak. So it's hard for people to suggest downside on EuroCAD. I think what people may be waiting for is just a bit of a reasoning for that to happen. But I would like more upside nevertheless, either from this 50% or even from here. If we create a nice high, we can get him. Euro GBP, ideally longs. Where are we reacting from, though? It seems as if we've reacted from this daily demand zone right here. That daily demand zone right there is where we've reacted from. We've rejected all the way through here. We didn't break any structure, so obviously we don't get in. But what we did see is a reaction from there. Now, what we have started to see is some sort of structure breaks. For example, the lows, nice little structure break. I don't think that's a breaker structure, though, because the breaker structure is technically, actually, this little high made the low low there. That then pulled back because that low created below that low. That made the low. It's a very minimal breaker structure. So it's a little bit on the risky side in terms of probabilities, but it would make sense for upside based on what we know. So it's completely up to you if you want to trade it. What I think what we may be seeing, let me see if we've got a demand zone somewhere. Doesn't seem like it. I would probably want to be around sort of that, these last lows here, right there. Between this sort of region there is of interest for me for an entry. Bit on the risky side, just because, again, you can see that this wick or this body candle close didn't close above the high. It's just a little bit on the risky side. Euro yen, I mean, obviously the yen is a little bit weaker today, but I think that's more attributes because of dollar strength. But for now, Euro New Zealand is kind of following EA, to be honest with you. So I think that's what you probably would need to look for. Where are we trading to, though? Probably around that 6 hour, which we look to be reacting a little bit out of at the moment. And then obviously we do have sort of that zone there. So those two zones would be the region of interest from a technical perspective. And then lastly, euro dollar, we had a nice reaction out of the daily demand zone right here. Cool. We had a nice breaker structure here. Actually, technically, we're looking at it from a technical perspective. Breaker structure didn't actually occur here because the candle body needs to close below the wick, which was created there, which then created the pullback. So technically we didn't break any structure, but what I would argue is it would still make sense for upside based on what we saw this week. So if you can get in, then a good region of interest, if we really drop down to the lower time frame, would be, oh, I can't even eliminate that wick. Yeah, I can't eliminate that wick, unfortunately. So yeah, the only region then of interest would be pretty much around this 2 hour to 4 hour area of demand right here. And it seems like that is the case. I mean, technicals right now, starting to turn bearish in the lower time frame, could suggest a bit of a pullback. But then I would be interested in around that region for maybe a little bit of a higher move towards the previous highs. Because what we've seen this week would suggest upside in euro. But yeah, apart from that, that's myself on all three currencies. So far, so good. I mean, what we spoke about still is expected, or the expectation is still for those trades to continue. That's cool. Next week is obviously very, very important because we have like the Fed meeting, we have the BOE, we have inflation from the UK, we have a lot of important data next week. So hopefully we can sort of get into some of those trades. But for now, though, those are my three views. Let's move straight on to the Australian. So the Australian dollar and of course the New Zealand dollar. Obviously, this week, we haven't really had any major data for them. If I quickly show my screen, let's just refresh our memory if we've had anything. But so far, what you have to be thinking about is what is the main driver of both currencies. Well, so far, as you can see, we really had nothing. Hawkesby, I didn't see anything of interest online. But overall, the main driver of both currencies, as it seems, is the S&P. Because the S&P basically is a good indication of people's risk appetite. If people are more happy to take on risk, i.e. stock market, stocks are risky, people are more likely to buy, or investors are more likely to buy into what currencies are also, in quotations, risky as well. Volatile currencies, let's say. Australia and New Zealand are volatile currencies. You know, they move quite aggressively. They have a lot of pip count. You can make a lot of money from those pairs, but you can also lose a lot of money. So this is why there's that correlation. So as a result, all we have to be considering at the moment, until we have anything of interest, let's just double check next week. Next week, okay, towards the end of the week is also pretty important for Australia. Those are two important bits of data. But right now, what we have to consider is, well, if we look at it from a policy perspective, the BNZ is a lot more hawkish. The RBA, sorry, is a lot more hawkish than the Fed. So even if it wasn't going with the S&P at the moment, you could basically suggest that you would still want to be long the AUD because there's that central bank divergence. Obviously, The S&P higher is a really good sign for further gains in pretty much both currencies. So far, that's all you have to really consider. I mean, I've had a look at other people and what they're kind of looking at. I'm not really seeing anything out the ordinary. I mean, I'm looking at UBS. They haven't even mentioned either currencies. I've had a look at JPM, which they normally have the AUD and the NZD on there together. They haven't really spoken about it. So for both currencies, it's going to be a quick one, really. All you're focused on is why would the S&P go higher? That's the question you're asking yourself. Well, the reason it would go higher is because as follows. Dovish Fed. Do we think that's going to happen next week? Likely, because we've seen the data over the past couple of weeks being pretty poor. So the likelihood of them being hawkish is pretty slim. As a result, we have to think, okay, cool, they're likely to be dovish. Perfect. That's bullish for equities. That is then bullish for AUD and to some degree the NZD. The reason I say to some degree because the RBNZ is pretty dovish. So if I were to trade a currency out of those two, it would be by far the Australian dollar at the moment. So that's the reason we're thinking about is we know the Fed's likely to be dovish next week. That's obviously bullish for equities. That's then also bullish for AUD and, of course, to some degree, the NZD, as we've seen with price action. So that's all you're thinking about for the time being until we have any major data that could be considered. Next week's employment data is obviously important, but Australia's employment data has actually been relatively steady. I mean, the unemployment rate, as you can see, has been pretty stable at around 4.1 to 4.2%. That's perfect. It's not really increasing. Whereas if we can compare that to this one, and that was last, we need to go to last week. And you can see the unemployment rate for the US is starting to rise now. Starting to see that sort of rise. Canada as well. Where am I? Canada. You can see how that is starting to also rise as well. So that's why you're considering that the labor market in Australia is actually still pretty stable. RBA is hawkish, higher S&P, very good for AUD. NZD is pretty much following the AUD for now. It's following it for the past couple of weeks. Before, it was following like what the RBNZ was doing, pretty dovish. NZD came under pressure. We saw that like sort of like Euro New Zealand higher, GN higher, but we're seeing a large reversal, and that's largely attributed to the S&P going higher. So yeah, that's all you really have to be focused on for now, is purely what the S&P is doing. In regards to Canada, let's have a little look. So Canadian data this week, if I remember correctly, I don't think we had anything. So this is this week, by the way. You can see that we've had nothing. Next week is obviously going to be important because, as you can see, we have CPI, big bits of data. We need to consider these two, but I'll speak about it on Tuesday anyway. And then the Bank of Canada on Wednesday, which so far people are now considering that we should actually start to see some rate cuts from, when do they expect it? I just want to double check. In the wake of large GDP and unrealized tariffs will continue. We look for a 25 base point cut on Wednesday. I mean, so far the forecasts are for not a rate cut, but obviously I have seen that change when the new week comes, that now people do expect from a forecast perspective. I would agree that rate cuts should be resumed just because we've seen like a large amounts of rises in the unemployment rate. Employment data has been really poor. The employment change in particular has been really poor. That does tell me to some degree that they should technically start to cut, because like I've said before, when a trend starts to form from a data perspective, it doesn't just suddenly stop and then reverse itself. When a trend forms, it really drives. Hence why when we've seen all of this weakness in the US labor market over the past few months, it's picked up. It's not just one, it's created a trend and then it just suddenly goes back to being really strong. Inflation can do that because it's very chopping, like it's very volatile in terms of like wars can impact it, or weather can impact inflation. That's very volatile components. But employment, it's like it's the anchor, one of the anchors of an economy. So that's why it can drive really far. As a result, they have to cut in anticipation of weaker employment ahead. They're not going to wait for it to be really weak and then start cutting, because remember, interest rates doesn't start to show into data until about 12 months, 6 to 12 months. So from that perspective, they have to get ahead of the curve. Hence why you can probably start to see now that people now start to believe the RBA, the BOC, can cut interest rates further. That's all I have to add on to that, because we've not really had anything else. I guess if you want to look at the comparison between the dollar and the Canadian dollar, you can see that sort of weakness from the CAD as well. But even fundamentally, it's not good. So you can see we were still looking for buys on AD CAD being very, very, very shallow pullbacks. So I think we have to work with that for now. Let me actually delete this. We don't need that. So for now, I would be more on the camp of shallow pullbacks. We all know the ideal scenario is like a really big pullback, but there has to be a reason for that. If we haven't got that reason, then obviously we think shallow pullbacks. Because we haven't got it, we just think shallow. So for now, probably around here to around here as the two regions of interest, basically here or in this region there. And then we can see it from a price action perspective. ADJPY, I mean, it's not really doing anything. Still pretty bullish. The yen is a little bit weaker, but that's largely because probably a bit of stronger dollar today. That's fine. AN, I am not looking at, but I'd rather be long this than short it for sure. ADUSD, as you know, obviously massively long. Very shallow pullbacks, probably around here. Then Swissy, I am not looking at. CAD JPY, we are, but you can see it's actually pretty similar price action to dollar yen in recent times. So I think we have to wait for better price action from a breaker structure perspective form. Have we got any supply zones at the moment? Probably not. Actually, we've actually reacted out of this 4-hour zone there. So actually that looks pretty decent. I wouldn't mind a pullback into that, and then I'll look for a sell. It's a little bit on the risky side though, just because of a bit of weakness in the yen. NZD CAD, rather be long this, similar to a UD CAD. And then we're actually reacting out of this 4-hour right here. So that's what I'll be watching right now. We reacted very nicely. Price action so far looking okay. Looks pretty decent. NZD USD, NZD yen, obviously I'm not looking at, but I'd like some sells. And then NZD USD purely being driven by the dollar leg at the moment. Doesn't seem like we're reacting from much at the moment. You can see it's been very shallow pullbacks on these pairs. And that's because, remember, pullbacks have to happen for reasons, right? So if there's no reason for a major pullback like that, then it's just not going to happen. So you can mark out all the technicals you want, but fundamentally, if it doesn't make sense for a pullback to happen that far, it will never reach that until it has a reason. So right now, we seem to be reacting. Yeah, it doesn't seem like we're reacting from any demand zones at the moment. Obviously, it is Friday. And again, ideally, you don't want to be taking a trade late into the afternoon. But yeah, I would probably want to be looking down a little bit lower, or if we start to see some sort of break. So for example, we break above that high there, then I'll get in. I'll wait for a little bit of a pullback and then I'll look to get in. So that's myself in all three currencies. Let's move straight on to the yen and the Swiss. So the yen and the Swiss. In regards to the yen, you may have seen a little bit weaker today, and that's largely attributed to a little bit of a pullback in the bond market. So if I just quickly share my screen, and that's all I could really find online about it. Fundamentally, it still does make sense for further yen gains, because again, as the labor market weakens, you would expect like the 10-year on this chart to come in lower, and that should allow the yen to sort of strengthen as well. This is actually known as a bear steepening of the yield curve. But yeah, overall, that is generally not a bullish trend for the yen over the shorter term. But like we know, the key word is shorter term. It's not a fundamental shift. It's a shorter term short term, right? So if I just quickly share my screen, I've got one thing from the yen, and this is what Nomura has to say about it. So they go on to talk about the politics, of course. And then they mention towards the bottom here is Koizumi's absence from the race wouldn't necessarily mean the landslide victory for Takaichi, in our view. Koizumi supporters inside the LDP could very well back other candidates, especially Hayashi. However, such a scenario would leave the market to Takashi having a larger advantage than previously expected, which could trigger additional selling pressure on the yen, creating strong headwinds for our short yen trade positioning, which they're targeting for 142 by the end of October, with conviction rating of 3 out of 5. So you can see that they were looking for more sells on dollar yen, which I agree with. And the only thing that's holding the yen back slightly is just this politics at the moment, because you can see here, BOJ has gained decent flexibility in deciding when to hike its rates. Most people are expecting October to December. It's either one of those meetings. They are expected to hike at least once more this year. But all we have to do is, I think the only thing that's kind of stopping the yen from rallying a little bit more aggressively is just this political situation, similar to France, right, and euro. That at the moment is contained, hence why markets aren't really, they're not trading that in the angle of really weak euro because of French politics. They were when it first happened, but then they, probabilities would suggest that it would get sorted, as it has done a few times the past year now. So for now, I think you do have to be considerate of two things, which is number one, the dollar, which should continue to weaken. As a result, the yen should strengthen. And number two, politics from Japan. So just do a little bit of reading on this and kind of what that means. But again, like they're saying here, candidates for the LDP presidential election have become clear. Apart from Shigeru Koizumi's candidacy, we should not rule out a tail risk scenario that Koizumi may not run up the upcoming election, and this may trigger JPY selling. So just consider this person here. Just watch, look on Bloomberg or Reuters, which is free. Reuters is free, of course. Bloomberg isn't. But yeah, apart from that, that's myself on the yen. In regards to the Swiss, I just wanted to see if they do talk about it here. Swiss, I don't think they've got anything right now. No, they haven't really got anything right now, apart from strong again with French politics, Middle East wobble. So they're just purely risk sentiment. Swiss, according to UBS, is benefiting from the French politics situation and Middle East wobbles, which we saw on Tuesday during the breakdown, actually, that when Israel bombed into Qatar. So far, not seen too much update on that, so it's not tradable. But obviously, as you know, if it does escalate, then it becomes tradable, and that's when the Swissy will gain from that. But for now, it's stable. We haven't seen too much update on that. So for now, just purely focus on the French politics. I personally wouldn't trade the Swiss right now. It just seems a little bit choppy across the board. So it's not really an environment we want to be trading. And then lastly, gold. Gold-wise, I do still think it's upside. I mean, we've had pretty shallow pullbacks. I mean, actually, to be fair, we actually just missed this. We actually came just into the high here. Just into the high there. And we had a nice push out. And then it's been pretty choppy, chop. But I do feel like we can still go higher. Because again, dovish Fed, weaker data, suggests higher gold, lower bond market in terms of lower yields is bullish for gold, by the way, because it doesn't attract investors to buy yielding. It attracts them to buy non-yielding bearing assets. So as a result, you can see it's been shallow. And hopefully next week, we can capture a nice entry on around. If we break above this high today, even if we don't, but if we at least break it next week, this high, then you can see that there is a demand zone right there for you to trade, because that would be quite shallow pullback to then go back up again. But remember, it's the Fed next week, and that is the main event, really. So for now, I still think gold can go higher based on what we know, because of data is suggesting dovish Fed. But it's up to you if you want to do that or not. If you want to trade that expectation, it's completely up to you. Obviously, it's personal risk sentiment, or it's up to you in terms of how you want to be trading fundamentals. Some people like to trade the expectation of something because it suggests it. Some people like to wait off and see what happens. I'm fluid. I'm sort of trying to do what makes sense for me at that time. But I would be in the camp of trading in anticipation of a dovish Fed, because it kind of tells what we've seen over the past few weeks has suggested a Fed. So apart from that, that is myself on today's breakdown, being quite informative, if I must say so myself. Next week is going to be very, very important because we have a lot of important data. So for now, that is myself, and I will see you next week, everybody. Have a good rest of the weekend.